Happy Tuesday,
Hey, everybody.
everybody.
Happy Tuesday. Happy SaaSpocalypse 2026 to all that celebrate.
I don't
Happy
know
your
if we're called
portfolio is
celebrating.
bleeding red.
Well, maybe you celebrate it because it gives you some opportunities. You know, one of the things that I said is huge sums of money, fortunes will be both lost and made as a result of this.
That's right. And if you can't have a good sense of humor while you're losing money in the markets,
Then what's the point?
you're doing it wrong. Totally. Somebody's going to make a fortune. Somebody's going to lose a fortune. And our goal is to help you figure out how to make the fortune from this. So good morning to, I see Mark is here. Some is here. Bruce is here. Klaus is here. We have people from Copenhagen and Latvia, all the way from a great state of Texas. Thank you guys so much for joining us today. Our goal here is to make this absolutely worth your while. So, Stoffel, what are we talking about today?
Today, we are talking about the subject that should be on many investors' minds when it comes to technology stocks, especially software stocks. And that is, and you know what, Mr. Foldy, I think that I'm having trouble adding my thing. Do I need to? Oh, okay, wait, ready? There we go. All right,
there
now
you go.
Which is being able to pick and decide which SaaS and SaaS-like companies are not only going to survive in the age of AI agents, but thrive in the age of AI agents. And Brian, one of the things that is worth at least getting out of the way is, what is this all about? Why is there a panic within this certain subset of the market? There's really three reasons for it. The first is, with the advent of artificial intelligence, there's a belief that software has become a commodity, that it will be vibe coded away, that anyone will be able to create code to run their own programs, and that there's really very little differentiator anymore. And because of that, number two, growth will collapse. So why would I pay a company to run software on my servers when I can figure it out all by myself? Because if I can, then I'm going to save myself a lot of money. And I think this one is incredibly important to remember, because I think it's true, is that predominantly, historically, they have not, software as a service companies have not been run super efficiently. They've been hiring like crazy over the past decade. They hand out tons of stock-based compensation. And so, Brian, as of, I think it was yesterday, this is how much a lot of big software names were down off of their 52-week highs. And
Wow.
Brian, I look at that list. I mean, geez, look at Figma down 85%. Axon, one of my favorites, down 51%. I own 4 stocks in there. I'm curious, Brian, do you own any? You don't even need to tell us which ones, but do you own any of those that are in that list?
Yes.
Okay.
Yeah, 3.
And I'm curious of the people here, because look, misery loves company, right?
Totally.
So just so you know, you're not alone. I'll go back and show that slide again. My question to you, you can type it in the chat, whether you're on X or YouTube or wherever watching us. Do you own any of these stocks? And if so, how many? I mean, look right here, Trade Desk. I mean, man, Brian, that has been like one of the most painful ones to own, down 80%. Joseph has Axon.
That's one of the ones that I own.
Yeah, there you go.
I can say, despite being down 80%, I'm still up on the position. So it's been a great. So
what does that mean? It was more than a 5-bagger at its height.
Yep. And this has happened to me on a lot of high flying stocks that I've owned. They go through periods of extreme highs and extreme lows. So if you're a long-term investor, and if you've owned, Netflix, Intuitive Surgical, Apple, Amazon, this is like par for the course, right?
Yeah, look at Roman's got 13 of them. I mean, that's a lot. Whereas there are some who don't have any. So the point is that, hey, you're not alone, right? Brian is in this basket. I'm in this basket. We're all going through this together. And if you've avoided them, good for you. But hey, don't miss this opportunity that might be in front of you right here. So here's our goal in your 1 hour with us today, is that by the end of it, you will be able to use 4 different frameworks to analyze risk and reward in the age of AI agents. Now, those 4 frameworks are going to be, we're going to look at this through the framework of liability, like the legal risk and the accountability of getting something wrong. We're going to look at this from a business model lens. We're going to look at it from a, hey, does it touch the physical world? Is there hardware involved? And finally, is there a network effect? We're going to look through all 4 of those lenses. And hopefully by the time we're done, we'll be able to suss out what is going to be able to withstand it, what is very weak in the face of AI agents, and what could actually get stronger. So Brian, let's start out at the beginning. And I will say this one is a little bit tough because I think it's easy to get it backwards, what we're thinking here. And that's the liability lens. Like, what is the cost of failure? Is it high? Now, Brian, when we first did this, and we did some work with AI on it, it thought that if the cost of failure was high of using AI, then that would make a company's software fragile. But that's not the case, correct?
Yeah. So the question that you want to ask here when analyzing a software company is, are failures or are hallucinations tolerable to the organization?
Right.
In the worst case scenario, meaning your business is at risk, the answer to that question is yes. Hallucinations are tolerable. From a business sustainability perspective, the best answer is absolutely not. Any hallucinations or incomplete data or incorrect data is absolutely catastrophic. That makes your business more resilient to the AI changes.
Exactly. So let's just think about this for a second. Okay. If you run a SaaS company that helps with marketing copy or basic code generation or graphic design, then if an AI bot, if ChatGPT, if Gemini, if Claude Cowork is right 90% of the time, and that's fine, then you're in trouble, because guess what? Claude Cowork and ChatGPT's OpenAI's Frontier, that's right 90% of the time, and that's okay. That's actually not a good thing for you. If it's probabilistic and if it's right 90% of the time, there's a good chance that people are at least going to consider replacing your software. If, on the other hand, a 90% hit rate by ChatGPT or Claude or Gemini, 90% is catastrophic because of the mistakes that happen on the other 10% of the time, like medical diagnostics or cybersecurity or grid management, well, then your software probably is not high on the list to get replaced. Okay. So the key insight, and again, this is a little bit counterintuitive, is you want to look for stocks where the cost of that software hallucinating is too high. Okay. You want one where it has to be exactly right, because that cannot be replaced with a large language model. Did I catch that? Does that seem about right, Brian?
Yeah. The idea is simple. Is a company that makes software that manages the electric grid, right? Are they going to vibe code software to change that away? Well, if that vibe coded software worked 98% of the time, right? 98% of the time it was correct. Well, that means the grid doesn't work 2% of the time. That's catastrophic. That's absolutely catastrophic. For cybersecurity, it's way worse, right? You need a 99.9999999, like the number of nines you demand from your software is huge. On the flip side, if we're writing a marketing email, or if we're designing a graphic or something like that, and it hallucinates, that's not catastrophic. You can just try again without any error. So that would be a business that's at risk versus the other.
What I would say about that too is I think that's why, and that Figma is down so much, because one of the things that Adobe has that Figma doesn't have is indemnification. They have, their software is created such that it won't hallucinate and change a logo and then have that go out live, and then that's a serious problem. Adobe does have that, Figma doesn't. But let's give some other examples. So Chegg is an education company that basically students would go to for help with homework. And think about it. Is the cost of failure that high? Well, look, I would actually argue that with Chegg, if a student was cheating by going to Chegg and getting 100% on everything, that would actually be a problem. Getting 90% right is good. It doesn't put you on the teacher's radar. So if you can use Gemini to replace Chegg, that's terrible for Chegg. And lo and behold, that's why Chegg has absolutely cratered. On the other hand, we've got Viva Systems. They are the system of record for large pharmaceutical companies. They store all their data for clinical drug trials there. If anything is hallucinated there, then life-saving medicine never makes it to patients. Humans have to stay in the loop. You can vibe code away Chegg, probably. You probably don't want to try and vibe code away what Viva Systems does.
Yeah,
so
not
that's
to
our
mention
first
if they're submitting for FDA approval and that's denied because something is incorrect or there's an hallucination identified, not only will that cost the company perhaps months of time, if not years of time to fix, you're talking about millions of dollars on the line. So yeah, do I think that someone is going to vibe code a Viva system replacements? I don't think so.
Nope, I don't think so either. So that is the first of 4 lenses. I don't see any questions popping up because feel free to ask questions in the chat. But let's.
Neil noted that Figma was trading at a ridiculous valuation, which is why it's been hit the hardest for sure.
Yeah, absolutely. Let's move on to our second one. Now, this is a big one. It's the business model lens. And the question you have to ask yourself is, this SaaS company that I'm looking at, do they charge for work or do they charge per worker? That is a huge, huge thing. So you have a fragile business if you have a seat-based model. Think of it this way. If cheap AI agents can do the work of 10 analysts, then those analysts get fired. And then the company that was providing the software solutions all of a sudden loses those 10 seat-based revenue streams. On the other hand, if you have a usage-based models, then AI agents can do the work of those 10 analysts. And think about it. Then those analysts get fired. The company keeps the salary for those 10 analysts and then just puts that towards paying for more compute. So if you have a usage-based model as opposed to a seat-based model, well, then that could be really good. So the key insight is find companies that capture value from productivity, not from the number of humans that are using the tool, because there is a difference in the age of AI agents between those two things. Now, Brian, I see we've got some questions rolling in here. What do we got?
Yeah. So Neil was wondering if you have a human reviewing the final output of something, say related to marketing, then the hallucinations don't matter, correct?
Correct. But what I would also say, but that's why, I mean, the thing is if you've got a human in the loop and hallucinating is okay 90% of the time, again, that makes it easier to be replaced. But the fact of the matter is you're not going to do that if you've got FDA approvals. There's certain areas where the stakes are just too high. The blast radius for being wrong is too big.
Right. Or take CrowdStrike, for example. It's not like there's a human reviewing every single attack that comes in and accepting it or denying it manually. Software is doing all of that for you. Software is reporting the analytics on it. And I'm sure I'm sure there's human reviewing what the analytics are doing, but the software is actually making the decisions. So again, a great example is like Chegg. If Chegg is reviewing your homework with you, right? Or Chegg is coming up with test prep questions. Is the cost of a hallucination catastrophic?
Right.
No, it's just not catastrophic. If CrowdStrike let the bad guy into a system, would that be catastrophic?
Yes.
It would be a decision. It would be potentially career ending, right? For the company. So the higher the risk, that of that accuracy or hallucination disrupts everything, the better that is for the company, because the less likely it is that there's going to be a vibe coded alternative.
Yep. And I think Phobos brings up a good thing. AI hallucinates a lot still. I agree. But here's the thing to remember, and that you have to remember about investing in the stock market. It is forward looking. Brian, if you compare what Gemini could do 6 months ago with what it does today, I mean, it's in a different continent, right? Which means that more than likely what Gemini can do 6 months from now compared to today could be in a different continent. I'm not saying I know it will be, but we have to take that into consideration.
Yes. Oh, absolutely. This is what we're trying to provide here is mental models for you to think through when you're analyzing a software company. These software companies are down. Wall Street believes that these companies' business models are permanently impaired and permanently disrupted. That might be true for some of them. What we're trying to give is, or think through, is the lenses that we can use to say, is that narrative really true? Or are these companies far more durable than Wall Street is giving them credit for?
Yeah.
And I've seen that we have some people that have said, what do you guys think of Atlassian? What do you think of Constellation software? So we have some examples built in, but we are happy to do some more, take a look at some specific companies later on. So if you have companies you want us to analyze or talk about, let us know.
Yep. So let's talk about this seat-based model. So remember, we did liability on one hand. If you cannot handle hallucinations, that actually is a great thing. Number two is, what is your business model, seat-based or usage-based? Now, Salesforce has been trying to pivot. And this gets to something that I believe Bill said a little bit earlier. Yeah, he said a lot of companies fall in the middle where they have some transactional characteristics, but Salesforce is the granddaddy of seat-based software. It is the granddaddy of SaaS. And so if customers cut employees, if IT departments and service desk departments get cut back, that hurts Salesforce because they are primarily seat-based. Agentforce is gaining, but the big question is, can Agentforce grow fast enough to replace whatever seats might be lost? That's why Salesforce is finding itself in a tough spot right now. On the other hand, Snowflake has never had a seat-based model, ever. Now, Snowflake's not perfect by any stretch of the imagination, but when it comes to this, Snowflake has never charged based on seats. They've only charged based on compute. And so productivity gains will help Snowflake as opposed to a seat-based model. All right. Any other questions you see coming up?
Is there anywhere in the financial statements to get an idea of hallucination rates? I can't imagine that would be in the financial
I
statement,
think
right?
The bottom line is this is all about how to think about the stocks that are, because the thing, Brian, is the baby's been thrown out with the bathwater over the past month.
Right.
And what that means is that there are some companies that are probably, we're going to look back and say we're screaming deals. And what we're doing is we're giving you 4 ways to find those companies. So let's move on to the third one, because I want to make sure we just have time to fit these in. So we've talked about liability. We've talked about business model. The third lens is the physical world lens. In other words, can an agent simulate something, or does it require real world feedback? So if a software company is purely software, that's it, there's no integrations, it's just software, then chances are more likely that it can be easily replaced. That makes it fragile. If, on the other hand, that software is integrated into hardware, it's in conjunction with tangible hardware, it cannot be replaced by AI agents. So you want to favor companies that integrate atoms, the real world, with bits, the digital world. And I think if we just give an example of this, this will make it so obvious. So a fragile company would be DocuSign. And think about it, Brian. DocuSign was created to take the physical contracts that we have to sign out of the real world. And that makes it, in this day and age, fragile. On the other side, I see Tim called this out right here. Yeah, Axon. Axon has tons of software solutions, but they are built in part and parcel to police body cameras and taser stun guns. And so ripping that out becomes nearly impossible, in my opinion. But any comments or questions about that part?
Yeah. No, that's a good one here about toast as well. Right.
Mhm.
So previously in, before this was an issue, I would have said that having a hardware component tied to your business was a net negative.
Because it lowered your
Personally,
margins.
because it's way lower margin, right? It adds inventory risk and all that kind of stuff. I now actually think that the adding a hardware or a physical component dramatically increases the attractiveness of the company, or at least an integration, because of this issue. Now, to be fair to people that may not agree with this, DocuSign as an example, we're specifically talking about this one lens to think through. DocuSign is protected, in my opinion, by legal rulings
Yeah.
and all kinds of like
Liability is huge, right?
jurisdiction. Right. So again, from a liability perspective, DocuSign can't be 99% accurate. It has
Yep.
to be 100% accurate 100% of the time, especially when big deals are on the line. So while it might be just a quote unquote software company, and it might quote unquote fail this test, I think that the other tests it would score much better on. But I love the idea behind this one. If you think about Axon, again, it's integrated to cameras, it's integrated to tasers. They have more physical components on the way. I think that dramatically increases the moat, or dramatically reduces the chance that someone could vibe code a competitor.
I think that Manju is getting to what you were saying, Brian. One of the things that I find so interesting is back when you and I started thinking about investing, like the beginning of the millennium, it became like hard assets were Walmart's biggest asset. And then once Amazon became a thing, it went from being their biggest asset to their biggest liability. And all of a sudden, starting sometime around then, everyone was rushing to get out of hardware and into software because it had better margins. And now, as Manju said, it's almost like because AI commoditizes all this, it's like this pendulum is swinging back, and you want to have something that has both hardware and software integrated.
Yep. Yeah, it used to be asset. The push was towards asset light, aka software and servers, and now the market is seems to be, the pendulum is swinging back the other way towards not asset heavy. Take Tesla as an example. They've insisted since day one vertical integration. That's extremely capital inefficient. It's way more capital efficient to outsource everything, but by taking on the vertical integration, you increase the anti-fragility of your business, especially compared to peers. So I do think from a software perspective, from a SaaS perspective, those that have chosen to go no, we're also going to sell hardware, are actually at an advantage versus disadvantage.
Yep. So we've had liability. We've talked about business models, seat-based versus usage-based. We've talked about having hardware or real-world integration. Those are our first three lenses. And our fourth lens is the network lens, which is basically, does the data get better for a software company as more agents join? So a software company is fragile if data can be quickly migrated to a cheaper platform. It is anti-fragile if two things happen, and it's really about context. If context plays a huge role in what a software company offers, and you need to be in their ecosystem to get that context. So like two-sided networks, like a marketplace or AI security databases, well, then the switching costs are much higher because you're going to stay because you want to be part of that network. So you want to favor companies that have such enormous data gravity that customers just can't afford to leave. Let's do a quick example here. So Asana, collaboration tool. Okay. I'm not saying it's easy to migrate everything out of Asana, but it is there are fewer barriers to entry to migrating all of your data away from Asana and either coding your own solution to it or going to Monday.com or Atlassian or what have you, as opposed to, say, CrowdStrike. Why is that? Because CrowdStrike is designed so that the cybersecurity becomes better as every single new customer joins, because it gives them more data points to detect novel types of breaches. And you only get immunity to those breaches if you're a CrowdStrike customer. So their scale is just unbeatable. And you don't get to take that with you if you leave. So that's really important. All right. One thing I do want to point out too, before we just move on to like putting this all together, is that we're seeing a lot of people bringing up a really good point of, what about an established user base? What about people that are already in a system? And they have a point. But Brian, here is the other thing that's important to think about. And I say this as a Salesforce shareholder. So let's be very clear about this. I own shares of Salesforce. I believe that companies have so much data stored on Salesforce that it's probably not worth the trouble to leave. However, that doesn't change two things. One, if agent force becomes important, then those companies could reduce their seat count, which is going to hurt Salesforce.
Yep.
But number two, and this is way more important, the ability, that doesn't mean that that doesn't mean that Salesforce is going to add new customers, because if a Salesforce-esque solution becomes available that's way cheaper than Salesforce, it might not lose its existing customers, but it's going to find it really, really, really hard to get the companies that are being formed today that are going to be the next Google, the next Palantir, the next what have you. And so you have to remember that, because that's a huge part of valuing a company, is what they're going to be able to grow over the next 10 years.
Yep. So it's very true that if a company is weak on these scales, they're not going to lose their business overnight, right? Software is pretty sticky. There are human components to it. The real question is, could AI slow their growth or or increase their competition, which in turn would lead to a slowing of the growth. So the businesses might be totally fine, like the business, right? The business might be fine, but if the market smells out this company's growth rate is permanently impaired, and the further out the company's revenue is projected, the more at risk that is, boy, does that collapse valuations, and that collapses multiples that investors are willing to pay.
Turn that terminal growth rate from 4% to 2%. That's different.
Enormous difference in valuation. So what that means is, while having high confidence in a company, let's just say it trades at 30 times earnings, having low confidence in a company, suddenly you're trading at 12 times earnings, and all of a sudden
you've lost half your money.
Same business perspective. That means the business is worth 60% less. Right? Same business, because the perception is future growth will be slower. So the thing we're trying to do here is, why are there reasons to believe that the perception on that future growth could actually be far more overstated right now than reality? And if you can find the companies that should continue to grow or have very robust business models that are resistant to this, we're saying that those companies might be undervalued today.
Yeah. So let's put that all together for everybody, because I think it's important to talk about. This is my opinion, and Brian, I'm curious about your opinion. We're going to put Axon through this, but you can put any company through this. I believe that you need to have at least one check mark in the green column. You don't need all four, but you do need at least one to protect you. And if you've got two, then I think it's really that's a great deal. So for instance, Axon, body cameras, stun guns, but also evidence.com, dispatch, and so on and so forth. Liability, the cost of failure for Axon is enormous. If you lose evidence in a trial, that's a huge blast radius.
Or if that evidence becomes inadmissible.
Yes, exactly. Now, business model. Axon is largely still seat-based, so it is fragile in that respect. Physical world, we already talked about it. Definitely anti-fragile. It's got the body cameras, it's got the stun guns, it's got drones. And then network effects, I think you could argue, hey, this police department can share with that police department, and that adds some network effects, and you lose that. You could argue that. I'm not certain that's super strong. But look, I look at this and I say, Brian, Axon's down 50%. It's got 2 check marks in this anti-fragile category. This might be one that I want to spend more time on. But let's juxtapose that with HubSpot. Okay. So HubSpot is particularly
Explain
focused
what
on,
they do for people that don't know.
yeah. So they're focused particularly on small and medium-sized businesses. And they have a hub for marketing, and they have a hub for operations. And basically it's where like your I don't know, 10 or 20 employees in the marketing department can have all their stuff together. They can generate emails really quickly. They can run things, they can track projects, things like that. The liability, I wouldn't say if I need a draft of marketing copy and it's only 90% what I'm looking for, then that's not the end of the world. So is the cost of failure super high? Nah.
And as
Is
somebody said before, there's also human intervention, right?
exactly. Business model. It is totally seat-based, fragile. Physical world. This product is totally bits. Now it's entering areas like manufacturing, small, medium-sized manufacturing that deals in the real world. But what HubSpot offers is still just in the physical world. And what about more agents making it better? I mean, there's that thing that we've heard about all the time, Brian. It makes their AI better. Okay, fine. But I'm not certain that makes it anti-fragile. So I look at this and I'm saying, HubSpot might be okay, but if you want to really benefit from this SaaSpocalypse that's happening, focus on the ones that are in the green. But those are just two. Brian, do we have some examples that we could go through, and maybe you and I could just think through this?
Yep. So Tim asked about the trade desk.
Okay, let's do this. All right. So we'll substitute the trade desk in here. You know more about the trade desk than I do.
Yep.
So let me ask you.
Trade Desk is an ad buying platform. You go to the Trade Desk when you want to spend money buying ads across the internet and you don't want to deal with the walled gardens that are Facebook and Google, essentially. You basically buy the rest of the internet in one spot. And they also have a business model that is used by agencies and big brands. So if you have money you want to spend, you don't want to depend on Google exclusively. You don't want to depend on Meta exclusively. You want to buy advertising space across the internet, anywhere else that you can buy advertising space. That's what the Trade Desks helps you to do.
All right. So what is the cost of failure? If I get AI to do my programmatic advertising buying and it's right 90% of the time, is that a serious problem for me?
I don't think so.
I don't think so.
You obviously don't want it to happen, but I don't think it's like career ending. It would just be wasted spend.
So I would not give them a green for that. Let's think about business model. Now, for business model, I believe it is completely usage based.
Totally usage based. Your costs basically scale with your spending.
Okay, so I give them a green there. What about atoms versus bits? Totally pink and red.
I'm pretty sure they allow you to buy on the internet. There might be some off internet buying, like you could buy like billboards and stuff like that, but I wouldn't say that is integrating real world information. They do have lots of data sources that I think might actually come from the real world that help you to make your ad buying better, such as like where you physically are in the world. So I don't have a full answer to that one. If you force me to choose something, I'd say robust.
All right. And then how about the last one? If I send, if I use Trade Desk, does it become more valuable for you as a Trade Desk
user?
Not
for me as a user, but they do have integrations across the entire internet. And I don't think that you could easily vibe code something that has relationships with like usatoday.com or CNN.com or any. It's not like you can vibe code those relationships. They are integrations that are built in. So it's not that there's a network effect for users, but there is a little bit of a network on where you can actually do the buying. So it's not that I don't think the network gets stronger as new people use it, but there is an interconnected web kind of behind the scenes.
So you might make that robust, maybe.
Yeah.
Well, let me ask you, Brian. You were working on something. Do we have something we can show folks?
Yeah. So I've been working on an AI prompt that
I submitted so you could share.
Yeah, that we can test some of this out to see how this does. Obviously, it's not going to be 100% accurate all the time, but I did queue up a prompt here that will know companies better than kind of we do. So here's what the prompt looks like. And let's just try it out. So I'll just start a new chat here. I'll use Gemini. I'll put this prompt here. And is there a company that somebody wants us to analyze?
Yeah, a lot of people put in ServiceNow. Let's put in ServiceNow.
Okay, so let's do ServiceNow. I think that's ticker symbol NOW.
Yep. So this is going to put it through those 4 lenses and also give us a final score. Is that right?
Yeah, it should. Yeah, if all goes well. But like anything with AI, we're going to have to analyze the results ourselves.
Right? 90% is okay for us because we're not claiming that this will be 100%.
Right. So it says ServiceNow is in a complex position. While it is the operating system for many large enterprises, its current financial structure is heavily tied to the very thing AI is designed to reduce: human headcount.
All right.
Okay. Its overall rating is
a
robust.
Business model problem.
Yep. And the confidence level in that score is high based on its most recent 10K in earnings data. So the key insight: ServiceNow has immense data gravity and serves critical functions, making it hard to rip out. However, its revenue model is structural ticking time bomb if AI significantly reduces the number of employees required to run enterprises' workflows. So I think that's a pretty fair analysis.
Like Salesforce is. They are trying to shift that.
Yep. All right. So let's go one at a time. So from a liability perspective, if this makes an error, is that a big deal? It says yes. So error cost is high. ServiceNow remains critical IT infrastructure, security operations, and AR compliance. A 90% case is a security patch, and payroll workflow is catastrophic, requiring high governance. I would agree with that.
I would agree with that too. So, and this gets to HS asked us to explain, if hallucinations are catastrophic, then that makes your SaaS offering more anti-fragile,
more
it can't
stronger,
just be replaced away,
harder to rip out.
Yep.
Okay. Number 2, the business model. This is where it gets a weak score. Okay. So it's a seat-based dominance. Per the most recent quarter, most recent year, 95% of revenue is subscription-based, primarily sold via seats. While they are introducing Now Assist consumption add-ons, the core revenue remains vulnerable. This is probably a reason why shares have been so slammed, right?
Yeah,
because
absolutely.
Wall Street is rightly worried about growth might slow if AI displaces workers.
Yep.
That makes complete sense. That makes complete sense to me. Physical world. Okay, this says red. It is purely software. While ServiceNow orchestrates work, it is ultimately a digital layer. It lacks proprietary hardware. An AI agent that can navigate web interfaces could theoretically simulate or bypass the platform's UI entirely.
Totally buy that. That seems reasonable.
It's weak there too. It does say network, green. ServiceNow sits as the system of record for enterprise workflow. This data is private, siloed, and deeply specific to each company. AI needs a proprietary context to be useful, giving ServiceNow a massive data moat that public LLMs cannot scrape.
So here's the one thing I will add to that. Now, again, I would say this as a ServiceNow shareholder. That network effect is important for existing customers.
Yep.
It doesn't matter a lick for potential customers, because if you haven't created that context on a system of record, then you don't care if you go to ServiceNow or something else. Again, I like to Iron Man the opposition. So I think that that's really important to keep in mind. I do agree that that would be anti-fragile for existing customers.
Yep. So the critical failure point is the seat squeeze.
Yep.
It is monetization lag. If customer uses it to third debate, they might be able to reduce their seat count by 30%. So it is transitioning to usage-based faster than companies, unless it can transition to usage-based faster than they can shrink their teams. The company faces a structural revenue headwind that no amount of AI-first marketing can fix. I would say that was pretty good analysis.
Yeah, I agree. That was pretty good. Now, Brian, we've already had some people saying that they want the prompt. What can we do with that?
So anybody that has signed up for our newsletter, if you can go here, if you're not, so every Tuesday we do a webinar at 12, and I will send out an email to everyone that RSVP'd for this webinar. If you want a copy of this AI prompt, just go here. If you could share that in the link, I'll do it actually.
Okay.
I'll put a link there. If you're signed up for our Tuesday webinar, just reminders, just put your email in here and I will include a link to a free copy of this.
And yep. So that is in the chat for you, brianferoldi.kit.com/Tuesdays Live, and we'll
Yep.
email you a copy of that one.
Let's keep going. Is there another company people want to?
Yeah, let's do one more. I saw Zscaler come up a whole bunch of times. Can we do Zscaler? I think the ticker. Oh, you know what? Yeah, let's do Zscaler.
Yeah, people are asking us about Constellation.
Yeah, I was thinking Constellation.
All right, we'll do one more after this. So Zscaler,
let's do two, and then we can move on.
That is positioned as the zero trust exchange. While it's running the AF security, its fundamental business arc contains a significant contradiction between high stakes technical mission and headcount linked revenue model.
There you go.
So it's robust, high confidence level. It's a toll booth for enterprise traffic. Its role is securing AI agents' growth. Its core monetization is tied to human users. If AI agents reduce the need for human employees, Zscaler's revenue could face a seat count squeeze. So obviously,
liability, that if it's cybersecurity, there is no
zero
doubt.
Right.
You don't
that
even
is probably
convince me of that.
Right. Fragile on the seat-based dominance. So it's primarily on a per user basis. So while there expands their workload, this might reduce there's a legitimate worry that it could reduce their growth rate.
Yep.
Fair enough. Okay. Hardware integration. Unlike pure apps, Zscaler operates a global network of 160 data centers, branch connectors, and chips. Much harder for pure AI agent to simulate or replace. I don't know if I buy that.
A robust.
Yeah.
One thing, Brian, that we've noticed is that if you ask AI and LLM to give something a 1, a 2, or a 3, it'll almost never choose the 2. It'll always choose the 1 or the 3. And we've seen that so far in this.
It's still helpful, right? But you have to do the work beyond that. And then network. Zscaler processes 500 billion daily transactions, non-public. Yeah, so this gets into is a human reviewing these? No, there's no humans reviewing 500 billion things. Non-public proprietary logs. This is a massive private data set that creates a moat public AI models cannot replicate. So again, this tells me it's almost like Stoffel. It's like this obviously reduces the chance of switching away. This reduces the chances of switching away. This reduces the chance of switching away. This one here is really about growth.
Yes.
You know, and this is about
whether or not they can pivot their business model.
Does the company have to change its business model to adapt to potentially a new world? And if you look at it through that lens, this is essentially, this is very multiple based, right? Like if the market sniffs out that growth might slow or the company's long-term tail is under threat, this is the one that really will worry them. So I think all these are important to look at, but if you're looking at can the company get re-rated higher? It's probably this one. That's a big thing to look at.
Brian, let's do one more. Let's do Constellation Software. And while we do, a bunch of people have asked if this would be added to the prompt library for Stock Simplifier. Is that something we can do? If for people that have already bought it.
I'm just going to email everybody. If you've purchased Stock Simplifier, you're getting these emails from us and you are registered.
So everyone's going to get
everyone that's registered. I don't know if I'm going to put it in the library. I'll probably just send it out as an email.
Okay. All right. What do they say about Constellation Software?
Okay.
An acquirer of vertical software solutions.
Yeah, is a federation of 1,000 small niche companies. Its strength lies in extreme diversification and the missing critical nature of its products. Software for cemeteries, public transport, or water utilities. Okay, it's giving it an anti-fragile rating and it has high confidence. While the software sector is panicking over AI eating software, Constellation is a massive beneficiary. They can use AI to modernize thousands of legacy code bases at near zero marginal cost, while their customers who operate in slow-moving, regulated niches are unlikely to build their own replacements. Okay, liability, anti-fragile. CSU's portfolio is built on vertical market software that runs critical infrastructure. If a water billing system or a hospital record is 90% right, it's a legal and operational nightmare.
Totally
I agree. Yep. Okay.
Hey, we got our first yellow.
Okay. Hybrid maintenance dominance. 75% of revenue is maintenance and recurring. Unlike per seat, much of this revenue comes from site licenses and support contracts for essential operations. It's less sensitive to headcount reductions than a standard SaaS company. Okay. I like that analysis. Physical world. Anti-fragile. Hardware process integration. Many companies sell software bundles with specialized hardware or
Yeah, like
integrated
utility
into
meters.
physical workflows like sensors or utilities. Pure AI cannot easily replicate the last mile. And
Yep.
then network. Proprietary context. COU owns the system of record for thousands of tiny niches. Because this data is non-public and highly specific, an AI agent is useless without the data CSU already controls. They own the context that AI needs to be effective. I got to research this company more.
Yeah, I'm with you. Brian, if you could let me share my screen again. The reason that we thought of this, Brian, was because we had some rather large and robust, interesting discussions happening about this very thing in our investing program called Stock Investing Mentor. And so what we want to do now is we're going to transition to talk a little bit about Stock Investing Mentor. This is an example of the type of content and topics, timely topics that we cover in Stock Investing Mentor. Let's explain what that is real quick, Brian.
Sure. So Stock Investing Mentor has 3 different parts to it. First is a weekly hour-long training session with Stoffel on topics exactly like this.
Yep. Thing number 2 is you get full access to my portfolio. Every single move that happens in my portfolio, you find out about and you get an explanation for it.
Third, you get access to the private online premium investing community where discussions like this are constantly happening. There are people asking, what software stocks are a good buy? Why are they good buy? Are you worried about? And this is the kind of debate that people have on our community.
Yep. So let's just dive into what each one of these is. So we meet on Thursdays at noon Eastern, and we rotate topics every Thursday. And we go through what we call the ADAPT framework, where there's a ton of different topics that we can cover. Now, everything is recorded if you can't make it, but we usually spend about 30 minutes practicing real life application and 30 minutes for Q&A for people to ask the questions that naturally come up.
So second, you get full access to Stoffel's portfolio. So not only do you see every stock he buys and he owns personally and the exact allocation, every time he buys or sells something, he actually makes a video that goes along with that and shows you all of the rationale for why he's buying or selling. One thing I love about this is Stoffel's net worth on the line. So 90% of his personal net worth is the stocks that he owns in Stock Investing Mentor. So if he makes bad buys or bad sells, no one feels the pain more than him.
Yep. I'll lose this if that is the case. And number 3 is our private online investing community. What this offers up is a chance to interact with investors like you. You get answers to your questions. It's open 24/7. And this is really important, Brian. I've heard you talk about this before. It is vetted. The conversations are only being participated in people who have paid money to join this community. So you can meet other members, ask questions anytime, and access all of the resources. This has been live. I think we're coming up on 80 weeks. So we've got 80 different lessons that you can access.
Yeah. The quality of the conversation increases dramatically when there's a paywall. That's just that's just a reality. So the team is led by Brian Stoffel, but there are some of us, such as myself, that do help out to keep the conversation going and to help answer members' questions. Brian is definitely the lead, though.
Yep. And so Jennifer here has been with us since the beginning, and she said she loves how personalized Stock Investing Mentor feels. And Brian, we talked about 3 big things, but we've also got some bonuses to throw in there.
Yep. First and foremost, you get access to Brian Stoffel's personal watch list. So not only are these the stocks that he owns himself, he also tracks a watch list that is in his universe, and he offers valuation ratings on all those stocks every 6 weeks.
Roughly every 6 weeks. Yep. Number 2, you get access to a free e-course that we created, how to find unlimited stock ideas for free. And so you get access to that as well.
Yep. 3, Stoffel builds custom tools that he uses to teach concepts such as operating leverage, optimize reverse discounted cash flow, and more. These tools are available for free to every member that is a part of the Stock Investing Mentor community. And we are taking advantage of AI to make these tools even better.
Now, Brandon, I want you to share bonus number 4, but first I want to answer this question from Brandon because I think it's so great. He says, how active are the members? Beyond being vetted with the paywall, if no one participates, it's useless. And Brandon, I agree completely. Let me just give you an example. last week was a little crazy, right? The SaaS stocks were selling off like crazy, primarily because we had Claude and Cowork come out, as well as OpenAI's frontier models. I was with my kids. They were sick. I had to spend a day away from the computer. When I came back, I had over 45 notifications for different conversations happening. So it is a robust participation in the community. Bruce is here with us, so he's in the community. He can vouch for that. But Brian, why don't you tell him about the last bonus, because this is a special one.
Yep. So for those that have been with us in this Tuesday session before, if you choose to sign up before the end of this live session, we will also include access to Stock Simplifier for free. So if you haven't looked at that before, Stock Simplifier is our tool that we use. It is a complete course that covers everything related to how to find, research, and analyze a business using our proprietary tool. It comes with all the AI prompts that we used in previous sessions to make that analysis effortless for you. So the prompts are included in there, and there have been requests to put this new prompt in there. I do take requests if people email me, by the way, but we will include that for free if you choose to join Stock Investing Mentor before the end of this webinar.
All right, Brian, since we put that up, why don't we throw the link in where people can sign up? But let's just finish up by doing this by saying, okay, so these are the things you get if you join Stock Investing Mentor. It's also worth pointing out, and I think that we shouldn't pass by this too quickly. If you're not happy with this, just let us know in the first 30 days and we issue you a full refund. We don't prorate it. We don't do anything like that. We give you all of your money back if you let us know, hey, this just isn't for me.
Yep. So one great stock investment idea that you get from Stoffel, or one piece of education that saves you from buying or selling something you shouldn't, or one connection to a fellow investor, those things can pay dividends basically for a lifetime.
Yep. So how much is this? Well, normally this is a program that costs $9.99 per year. However, because you were willing to join us on this, we have a special price that we are willing to offer, which is 20% off, $7.99 for a full year's membership to Stock Investing Mentor.
Yep. So Amit here has been with us from basically since the beginning here. And he says, if you want to be an intelligent investor, you should join Stock Investing Mentor. Amit has been a wonderful participant for us.
Yep. Or Paul, who said that this investment that he made paid for itself many, many times over.
Yep. Francesco said it was the best investment he made last year. He's been very active on our board, super participation in the private sessions that we have. And we love helping to educate other investors about how to invest the right way.
All right. So, Brian, if folks want to get Stock Investing Mentor and Stock Simplifier for free, they've got about 7 more minutes. Let's answer some questions that we usually get about this program.
Very common one. If you work full time, how are you going to fit this into your schedule?
We actually, Brian, designed this exactly with those people in mind, where, you might have family obligations, work obligations, community obligations. That's why we do hold it at the same time, Thursdays at noon Eastern every week. But we record everything. We release the slides for the coming week 6 days ahead of time, so you can look over them, ask questions, send us messages, things like that.
Yep, it's totally available offline. What about if you live outside the U.S.? Is this only for U.S. investors?
No, I would say anywhere between a quarter and a third of all of our students, all of our members are non-U.S. investors. So I invest primarily in U.S. listed stocks. I own companies that operate outside the United States a lot. But the fact of the matter is the dynamics at play in the U.S. is no different than the dynamics at play really anywhere else in the world. It's like gravity. Gravity is the same no matter what country you're in. So the lessons you learn, you can apply wherever you are.
How about if you sign up and realize, nope, not for me?
That again is just let us know in 30 days and we will happily issue a refund. In fact, we think that that's a win because you've discovered something that wasn't for you and you can move on to something else.
Yep. So we are giving you until this Thursday at midnight to capture this price. I will follow up with everybody by email, but if you want access to Stock Simplifier included, you'll have to use the link before this webinar ends, which is going to be in about 6 minutes or so. So you can still join at that price if you wait until Thursday to do it. But if you want access to Stock Simplifier as well included, you do have to join before this session ends.
Susanna, great question. Says, what if you're currently a member, like bought a quarterly plan, but want to extend it to an annual? simply send a direct message on our platform that we have on Circle, or you can send us an email, which is brian@longtermmindset.co, and we can help arrange that to make sure it happens.
Yep. There you go. Cool beans in the hub.
Bruce was here and he can tell us it's
Hey,
it's
Jermaine's
a big
here.
community. Yeah.
How you doing? How you doing, buddy? Yeah. The cool thing is I see lots of stocks that people are interested in talking about here. So very cool. That conversation, I'm guessing, will continue in Stock Investing Mentor from here.
Oh, you bet it's going to continue. I mean, we've got one more week on a specific topic, and I think that it'll be interesting to see how things evolve between now and 2 weeks from now. But as I said, we have a new lesson every week.
So, Brian, I know that you said you're a shareholder of Salesforce and of ServiceNow. These thinking through this SaaSpocalypse and the frameworks that we just came up with. One, did you use those frameworks before you bought those stocks? And two, have those frameworks changed anything about your portfolio?
So did I use them? Yes. Did I use them explicitly this way? No. Because it is something that we have spent a lot of time in our community thinking about. In fact, Ken Taylor, who I run this with, we've spent a ton of time thinking about this. So do we use it now? Yes. Like that hardware software integration for Axon is why I have it's one of my largest positions. It's fallen 50%, and I've been a net buyer. So absolutely something I've been using.
Do you use technical analysis in Stock Investing Mentor?
Here's the funny thing about it, Brian. I have been able to use technical analysis for trims, and that has worked out very, very well. Like very well so far. I sold Shopify at about 150. I sold Cloudflare at about 200. But I have not used it as well for buying into companies. And so that's where I'm trying to work on my discipline in using technical analysis.
Mm-hmm. So would it be fair to say that you use technical analysis around the timing of selling?
And I would say around the edges.
Yes.
So it wouldn't be included or not included in my portfolio just because of that. But if I'm like, okay, I know I really want to add to come up with a company name, but I already own 5%. I want to bring it from 5 to 7%. Then that's where I'll use some technical analysis to be like, you know what? I'm going to wait until the share price at least shows that it's established some type of support, and then I can buy that extra 2% position.
So as someone that has been skeptical of technical analysis for 23 of the 24 years I've been investing, I can tell you that my mind was fairly recently changed about it. And it was because of a combination of talking to somebody that uses it in their analysis and actually reading a great book that mentioned it. One thing that they said about technical analysis that really tweaked the way that I think about it is they said technical analysis is useful in judging the sentiment and the emotions that are related to a stock or a market. So if you think through it through that lens, not necessarily should you own this company, should you not own this company, technical analysis is useful for figuring out how does the market feel about this company. And if you look at it through that lens, it's actually useful. You think of it as a gauge for measuring the emotions of the market or the emotions around a stock. And when I looked through it through that lens, I was like, okay, that's actually useful information, right? The sentiment around a company is actually useful for thinking things through. So that's the kind of thing that you've taught people in Stock Investing Mentor about technical analysis.
Yes.
It's not that it replaces what you do.
No, you layer it on top of your fundamental analysis.
So when I looked through that lens, I became much less of a skeptic than I was previously.
Yeah. So, Brian, folks have about 1 more minute. If they purchase Stock Investing Mentor, maybe we can throw the link in one more time. But Janie's here, and she's in her 2nd year of Stock Investing Mentor. Says she looks forward to every session, learn something new every week, and access. Brian, this is your big thing. Like nobody joins for the community, but it is why people stay. Access to the main chat is another great learning resource, connecting with other members. And yeah, we look at all the feedback we get about this. So thank you, Janie, for sharing that. And hopefully we've got a whole bunch more people that can join, and together we can work to turn what is a little bit scary in this SaaSpocalypse and turn it into something that can be quite profitable for everybody.
So to hammer home that point, nobody joins for the community. Nobody.
No.
Like
Nobody.
they join because they want either the education or to follow your portfolio. Totally understandable.
Totally
People
good.
that really engage with the community, and once you get a community in your life, you realize how you are missing it. Once you get a gated premium community in your life, you realize how useful it is. How useful that part of it is. Investing is such a lonely endeavor. So many people are investing all on their own. They don't have people in their life that they can talk to about investing. Nobody's interested in chatting about investing. And if you just go and have random conversations with strangers on public communities, you've experienced firsthand that the range of people and participations is wildly all over the map. As soon as that conversation goes behind a gated paywall, the quality of the participation dramatically skyrockets because it's actually a person there with the same goals and the same goals as you are. It's just a night and day difference.
Hey, one more thing before we leave, Mr. Feroldi. You got a couple people asking what the book was that you read that helped convince you that technical analysis wasn't just sorcery.
The Emotionally Intelligent Investor by
Ravi
Mehta.
Mehta.
Yep.
Okay.
It was a decent book. It was all about the emotions, and again, this one he specifically talked about why he uses technical analysis to measure the emotions of the market. And again, that just flipped the switch in my head.
Cool. Great. I haven't read that, so I'll have to put that on my list. All right, Mr. Feroldi, next week we are back with our normal Stock Simplifier Tuesdays live. Do we have a stock picked out to tell people to be prepared for? Or I'm not totally sure.
I don't know what stock it is, but we do have one picked out.
Okay, well, we will be back here and we will run a stock through the Stock Simplifier, and we'll do it.
Give me 5 seconds and I can look it up.
Oh yeah, take your 5 seconds. And we're always curious to hear what stocks other people what stocks other people want as well, because that's, we want to know what stocks are on people's list. I was surprised no one mentioned Intuit today. Over the last 2 weeks, what everybody's mentioned.
So we did do a poll in our newsletter 2 weeks ago. We asked about 4 stocks, and the winner was Novo Nordisk.
Oh, well, it's been in the news a lot lately. So
ticker
that's
symbol NVO. So Novo Nordisk will be the stock that we are researching from scratch next Tuesday, and I bet the AI will find the analysis of them suing him.
Yes, yeah, I think that will be in there. All right. Well, we know an hour of your time is a big deal. We thank everyone so much for joining us. We'll be back here again Tuesday at noon Eastern, and we can't wait to see you then.
Yep. And if you want access to that prompt, sign up, register for these sessions, and I'll email you later today.
Okay. Bye, everyone.
Bye, everyone.